Bitcoin prices have rebounded to start the year after trading in a tight range following sell-offs in the fourth quarter of last year. Forced liquidations and selling by long-term holders pushed prices down as much as 35% from the October highs. You know who hasn't forgotten about Bitcoin? My next guest, John D'Agostino, Coinbase head of institutional strategies here. John, good to see you again. Good to see you live in person. Appreciate it.
Always love coming to see you.
So at its very simplest level, what is happening in Bitcoin? Help us understand this mini rally.
Sure. So I can understand why people think it's happening suddenly, kind of post New Year. The reality is, Bitcoin has been quietly recovering since a liquidity crisis around the early October. Now, liquidity crisis in cryptocurrency is a bit different from other markets because, unlike equities, for example, the market makers, the participants who usually buy and sell and bridge liquidity, they're not obligated to post bids and offers like they are in equity markets. So commodity markets and crypto markets are similar in that way. So on October 10th, we have what we call a liquidity crisis, which means people got scared. They got scared they were overextended on their balance sheets, and they pulled liquidity away. They just exited the market. And when that happens, you tend to get these violent gaps down in price because people are very, very scared about not being able to get out of their positions, and they'll sell at any price. That happened. It happens you've heard of flash crashes in equity markets, right? That's the equivalent.
I've tried to forget those, but yes.
Right, it happens in all markets. When it happens in markets like crypto and commodities where the market makers are not obligated to be in the market, they tend to be a little more severe. So that happened on October 10th, and it was scary. Here's the good news. The good news is you didn't have this rapid, violent unwinding. There were these support levels of institutional buyers. So retail panicked a bit. They needed to get out, but institutional buyers kept that ground, that foundation. Now, it was reported that there was this horrible liquidity environment, and so crypto kind of fell out of the news cycle for those 2 quarters, and you saw this sort of grinding down, sideways movement, boring price action. What was happening for those of us who kind of stayed active in the market was we were a bit confused because you had this horrific retail sentiment. You had this crypto Twitter and just Twitter X overall just being very bearish on the asset class. But what we were seeing at Coinbase,
Jim Chanos tweeting at Michael
it's all over, it's dead, it's going to zero, everything.
I hear you, brother.
And that's fine. I actually like those environments because you get to buy cheap things that people forget about. But what was happening at Coinbase is we were noticing, institutions were just gaining interest. So that period from October to December was probably one of the most active institutional buying periods. And there wasn't a single institution that was looking at Bitcoin and crypto prior to October 10th that suddenly stopped because of October 10th. So there was this huge bifurcation of interest. You had massive institutional interest and horrible retail sentiment. And so what's happening is since October 10th to now is you're seeing a bit of a catch up of retail sentiment, recognizing that institutions are still building and still growing. So I think of it less as a short-term spike and more as a sustained recovery.
Someone that I know told me yesterday, they said, Brian, this will be the year of tokenization in crypto. When you hear someone say that, what does that exactly mean?
Yeah, so it's a bit of a buzzword, right?
It is very much a buzzword.
And so I think of it this way. So I'm not that old, but when I got started, my first job—
Not old, period.
Thank you. But my first job ever as a young kid at a business school was the floor of the New York Mercantile Exchange. And this isn't 1960, this is like 2005. And it was still a bunch of guys screaming and yelling and trading open outcry. And my first job was to help shift that to electronic trading. So just basically removing the physical floor traders and what we call going upstairs. So digitizing that market. And that took a decade to do. And so think of tokenization as just the next step in that evolution. So it's shifting from the current way in which we record these transactions to recording them on blockchain. Now, why is that useful? Number one, blockchain is just better technology. It's faster, it's cheaper, it's cleaner. But more importantly, you can inject code into those tokens. They become smart. You hear about smart contracts or smart tokens. And then you can do lots of really interesting stuff. For example, there's certain reporting requirements that happen when you own more than a certain percentage of a company. All of that can be automated. So tokenization, it's not a scary technology. It's just simply that better way of digitizing that transfer of value across capital markets, whether it's equity, credit, commodities, crypto. Coinbase is kind of showing that now. Our new Everything app, Base, allows you to trade all those different assets on one platform. Now, why is that useful? Number one, it's convenient. Elon Musk likes to say the most entertaining option wins. He's a very smart guy, but I think
Smart
he's
guy.
wrong there. I think the most convenient option usually wins. And so how wonderful will it be if you can log into one platform and you can buy everything from a prediction market on real estate to Bitcoin to a tokenized equity all in one place. Not only is it convenient, it can be cost efficient because over time we'll figure out ways to cross margin all of those assets. And when you cross margin assets, you have to post less margin as collateral. That saves everyone time and money.
If we're having this conversation 2 months from now and Bitcoin's back at the highs,
Yeah.
what will have been the biggest driver of that happening?
My interview here.
Of course, right?
So I think
Buy now!
There's no, again, we love to ascribe, humans love to ascribe causality, correlation to causality, or confuse the two, I should say. So I think it's all the same things that's made Bitcoin valuable over the last 17 years since Satoshi wrote the original white paper. I won't hedge on this answer. To be more specific in this current environment, it's going to be regulatory clarity, particularly if the Clarity Act does get passed, but even if it doesn't, I think we have an SEC and CFTC that's never been more innovation friendly here in the US. It's going to be continued regulatory clarity. It's going to be the retail realization that this institutional adoption at both commercial and government level globally is the train's left the station. There's no going back. It's that. And then I think it's a stabilization of these market makers who went through a pretty scary period on October 10th. But the good news is, what we didn't hear this time, unlike prior flash crashes in crypto, there was no major insolvency. There was no FTX. Because these market makers, these big institutions, while they got a little bit wobbly that day, they were risk managing properly. So the realization that the market infrastructure has kind of grown up a bit and the probability of a large scale insolvency, I think, has gone down. All of that creates confidence in a high quality technology. People buy it, price goes up.